Welcome to Fall into ETF Investing, a special edition of ETF Market Insights. I'm Erin Allen, Vice President of Online Distribution at BMO ETFs, and in just a moment, I'm going to turn over my hosting duties to Pat Boland. But before I do, a quick reminder that today we're not providing you any investment advice or recommendations. Today's show is all about providing education around investing and around using ETFs for Canadian do-it-yourself investors. Pat Boland is a host of the Just Word podcast, where he tackles personal finance topics and investing topics. He's also an expert host and a media personality. So I'm going to turn it over to you now, Pat. Take it away.
Fixed income has had a challenging year. That might be an understatement. But despite that, it's still an important part of portfolio construction for diversification as well as risk control. It's going to be an important topic in the coming year. So joining us, Matt Montemuro is the Director of Portfolio Manager for BMO ETF's Fixed Income ETF lineup, and Marina Metz heads up the FTSE's Fixed Income and Multi-Asset Product Management and Research team in the Americas. Matt and Marina, welcome.
Pat.
Thanks, Pat.
Matt, I'm going to start with you because the central banks, and here I'm talking the Bank of Canada and the Federal Reserve down in the United States, have been very consistent in their messaging about increasing interest rates. Why are they doing that?
So the pandemic definitely forced central banks to be accommodative in their monetary policy decisions. You know, we saw the entire world shut down, and what they had to do is add cash to the system, lower interest rates, buy back bonds so that we could get a little bit of economic stability. And what's been the result of that is that, yes, we survived through the pandemic, but we also saw prices increase over time. And for a long time, central banks looked and they said, you know what, I think this is transitory in nature. I think this is caused solely by the pandemic. And now as we are moving out of the pandemic, we're realizing that those pricing increases, those price pressures haven't stopped, they haven't slowed down. And what that really has caused is the central banks to have to play catch up. We've seen interest rate increases of 50, 75, 100 basis points. Just a year ago, that would have been emerging market monetary policy decisions. Now we're seeing the developed markets have to go and play catch up on this fast pace. So what we're seeing going forward is that the likelihood of an economic slowdown, of a recession, you know, it's a near certainty at this point because these central banks are focused on one thing, and that one thing is inflation. So, you know, a lot of people ask, when is that going to end? You know, at what point are we going to be done with this hiking cycle? And looking forward, I think we are getting to the end, but we're not there yet. We're still seeing CPI prints in both Canada and the US at being well overheated and well above the bank's targets. So, you know, if you look at what the market's pricing in, I think the expectation is that we will start to see the slowdown of rate hikes in Q1 and Q2 of 2023. But I think we're going to see higher rates for longer. You're going to see a stop of hiking, you know, kind of in that early 2023, but then you're going to see the central banks pause, and they're going to see how that impacts the system for several quarters. It could be until 2024 until we start to see an easing, you know, a cutting of interest rates. And I think that's a little bit concerning for investors, but I think it's something that the central banks have identified as their number one goal, and that is to push, to cool inflation pressures and temper down price increases.
Okay, so then how does that, Marina, play out in the fixed income market?
Well, the number one theme this year has certainly been one of volatility, right? The market has had to adjust to a new rhetoric coming out of all of the central banks as they moved kind of in unison to dampen the pricing pressures. The market has had to price in inflation into the price of assets itself. And I think the market is still grappling about what does that mean kind of going forward? So how prolonged will the hike be? How far will the banks push it? And so we've seen this whipsawing kind of in the market. So we started the year, market was all down. Then there was a rally across G7 markets, albeit brief, kind of in July. And then that was totally overshadowed by a return to bear market in September as G7 central banks all released rate numbers, rate expectations, and the market has had to readjust. And, the Canadian yields are at a 3-time high. You've seen curve inversions of the 10-2 curve across most major markets, including US, UK, and of course Canada. And not surprisingly, credit spreads have also widened, right? So all of that means more volatility within the market and more for investors to grapple with. So not all bad. Canadian bonds actually fared relatively well compared to their global counterparts. And in Q3, you saw both Canadian governments and corporates gain. But what investors are demanding, we see, are precision in the market tools and precision in how they can potentially deal with what they're seeing in terms of volatility. Tail end risk events are becoming much more frequent, and so investors are looking towards how to manage that, right? So I said about the curve inverting. So what does that mean in practicality, right? So a curve inversion will typically be where the short-term interest rates have risen faster than the long-term rates. So the short-term rates are pricing in rate hikes, but the long-term rates are reflecting kind of slowdown in global economy, perhaps even recession fears, and so the curve inverts. What does that mean for investors? Duration management becomes absolutely top of mind, right? So this ability to pivot across curve, move assets, in reflection of what they're seeing in the market in a tactical way has been top of mind. And so we've seen investors look towards shorter duration allocations, hold to maturity indices, and typical kind of rate friendly products. So floating rate notes, inflation linked real return bond securities in Canada. And so that demand for kind of precision and tactical allocation is what allows them to better navigate, if you will, the volatility of the market.
Traditionally, though, when we're putting together a portfolio, it's 60% equities, 40% fixed income. Both those areas have suffered, and the media is jumping all over that. Is 60-40 still relevant, and where does fixed income play into that?
Yeah, you've definitely see the opinion pieces come out of the death of the 60-40 portfolio. And I think long term, bonds still have a very core piece in any sort of balanced portfolio. I think from a portfolio context, what you really want from the fixed income allocation is that long-term risk control, that diversification, so that offsetting risk. So when you are seeing volatility in your equities, you have some offset in terms of your bond positions. I think there's been a lot of recommendations as to alternatives, substitutes like alternative products, infrastructure, private credit. One of the challenges is in a normal market is that those lack transparency, they lack tradability, they track liquidity. And those type of things are key for when you are trying to have a long-term performance in a portfolio context. So, when we look at fixed income, during the pandemic, there were a lot of questions with yields at 1%. Well, how can I get any value? What's the point of having 40% of my portfolio if it's just yielding 1%? Well, fast forward, we've seen all asset classes kind of come down. So that's, compounding the issue. But I think as we look forward, you're seeing short-term rates of 4 to 6% in investment grade credit. So you're finally getting compensated from that bond portion of your portfolio. And if you look long-term, that's really where you provide that offset. You get income from the bond part of your portfolio, you reduce the overall portfolio volatility, and you're still able to provide upside with that equity allocation. So I think the comments around the 60-40 portfolio being dead, I think those are overblown. I think they were more of an anomaly and a very pandemic-specific response. But I think if you look long-term, I think bonds still have a core foundational piece within a portfolio.
Marina, what do you think?
Yeah, I couldn't agree with Matt more. First of all, fixed income is an important part of a total portfolio allocation from both a diversification perspective, a risk management perspective, and an overall vol reduction. I also think fixed income gives investors access to parts of the market that they couldn't normally get anywhere else out of their portfolio, which is large liquid pools of assets. So in the Canadian context, Government of Canada Treasury bonds, provincial securities, which today do have yield, but also highly liquid, highly tradable securities. It's a ballast for your portfolio. It's a diversification within your portfolio. And I think the story of yield and the reason behind why you invest in fixed income to begin with, which is the income component, cannot be forgotten. We're seeing provincials are, I think, somewhere around 4% right now. Your high grade, investment grade corporate book is at 5.20 at the end of September with a 5-year duration. Even a Government of Canada Treasuries, or the federal portion of the index allocation, which is Treasuries and Canada Mortgage and Housing bonds, AAA kind of rated credit, is sitting over 3%, right? These are yields that have not been had in the market for decades. And normally, as people have gone in search for yield, they would have had to move down really far down the kind of risk asset quality curve, or go into other jurisdictions like emerging markets, et cetera, in order to be able to have that kind of a yield pickup or an income pickup on a portfolio. Today, it's achievable with short-dated, high-quality domestic credit allocation, which is part of the reason you push into a fixed income allocation to begin with. So I think it's very much part of a total portfolio allocation. I think it's part of, the way investors plan for the future, especially when you have kind of long-dated horizons in your portfolio book, coupled with your equity or your other alternatives, makes a diversified total portfolio.
But if I'm not quite looking that long term, if I'm short term, I'm nervous about what's happening in the stock markets, even the bond markets, and I just want to park some cash. Should I throw it into a GIC because I'm getting north of 4% with a guaranteed investment certificate, or should I look at ETFs?
Yeah, so the one thing that we're consistently seeing investors do in the market right now is de-risk. Look to put money on the sidelines, see if we can withstand the volatility that is expected for the remainder of the year. And their options, like you said, Pat, is GICs, high interest savings accounts, ultra short-term bond ETFs, money market funds. So those are the several of the options that investors have to choose from. So why would you choose one over the other? I think one of the biggest drawbacks of a GIC is just that lock-in period. So for someone who's looking to park it park cash on the sidelines, if you don't know the exact term that you want to park that cash, if you don't know exactly when that opportunity is going to come, that GIC makes it very restrictive. It makes it very restrictive holding within your portfolio. ETFs, like something like BMO offers ultra short-term bonds, ZST, or ZMMK, which is our money market ETF, provide flexible solutions. It gives you a yield of in and around that 4.5%, also ultra short-term duration. But it allows you to be flexible and nimble with your investment decisions. If there's an opportunity in the market and you see you want to move into equities, you can easily go in, sell those ETFs intraday, and put that risk on. With a GIC, you're much more restrictive, and you have to be kind of set it and forget it type of exposure. So I think the reason why investors are continually choosing ETFs for these cash and cash-like positions is that ability to be flexible and remain nimble so that they can take advantage of opportunities when they arise.
Okay, we've touched on a couple of the BMO ETFs, and I wonder if there are segments of the marketplace, sectors even, that do better at this time than others might.
So I think that's a really interesting question. And picking up on Matt's point, the precision angle is really what investors, I think, are benefiting from, have been demanding, and certainly benefiting from. And it is an innovation, I think, that ETFs have been able to bring to the market. Just expanding on that a bit more. So, the fixed income market in itself has changed in its composition over the last, decade, if you will. From an example, and this is, due to issuance patterns, due to structural market kind of events. So as an example, 15 years ago, the BBB component of the corporate bond index sat in at around 15%. Today, BBBs are 40% of the corporate bond portfolio. They are also representing different sector allocations within the kind of book, right? So, when you think about the kind of short-dated, high-grade securities, you're thinking mainly of financial sectors. When you're thinking about energy, then you're technically into your triple B. And so what happens is the market is measured and tracked in these kind of long-dated, correlated aspects, right? So typically you think about the market in terms of its term to maturity, right? Short, mid, long. You think about it in terms of industry sectors, energy versus financials versus infrastructure, et cetera. Or you think about them in terms of quality buckets, right? So the indices typically will tell you what is AA high, what is single A, triple B securities. And all of these are then representative of the risk-return profile of the underlying sectors and the dynamics that play out within those sectors. And if you think about performance as a combination of kind of rates and credit spreads, then by that virtue, rates are impacted differently in the short and the long end of the curve. And then the credit spreads are representative of the type of industry in which those underlying assets operate along a number of other factors, right? And so what we've seen is, as the market has gone through this period of volatility, different parts of the market have reacted differently, right? So if you look at the credit spreads, financials, as an example, which were at their lowest, tightest spread over a year ago, have risen fairly fast in comparison to the other sectors and have widened significantly over other parts of the market, mirroring kind of the energy space where they sit today. Energy, on the other hand, has remained fairly flat versus where they were kind of buoyed by what's been happening in energy prices. And, you know, we've talked a lot about kind of where you are in terms of term rates and how do you balance for that. And so having these kind of precision tools or tracking that enables you to navigate or tactically allocate across these specific precisions in the market as that market tactically adjusts has been something that's been very demanded by investors and has really benefited them. And in that context, ETFs is probably one of the more liquid tactical ability to be able to go in and out into these parts of the market and play what you think your view is over the tactical short end as well as into the longer term.
So bring it home in terms of BMO ETFs and how that translates to the overall strategy.
So, like as Marina said, it's very important to allow investors the flexibility to pick exactly where they want to be on the yield and credit curve. So in today's market, you know, Marina already talked about the inversion of the yield curve, a very flat yield curve. You know, if we expect volatility to come in the fall and potentially early in 2023, you know, my preference would be from a risk return perspective to look at the short end of the curve. Focus on short duration products, focus on products, you know, take advantage of a higher yield in the short end while also reducing that volatility or that rate volatility, that interest rate volatility that we may see caused by the central banks and their continuing hiking cycle. So from an ETF perspective, you know, BMO offers a full suite of short duration products. ZCS, our short corporate bond, ZST, our ultra short-term bond ETF, and then something like ZSDB, which is a short discount bond ETF, which is for those more taxable investors, providing a more tax-efficient solution for investors.
So there is more tax-efficient way to approach the bond market than straight income.
Pat, there's no way to avoid the taxation of the fixed income side of your portfolio, but I think it is important for investors to be tax aware. It's important to understand the taxation of all the investments in your portfolio. And so for when you are looking at fixed income from a taxable lens, I think it's important to find a solution that provides the exposure you're looking for, but maybe in a more tax efficient wrapper. So at BMO, we offer several discount bond ETFs. So it's ZDB, ZSDB, ZCDB that provide a more tax-efficient aggregate bond exposure. And what we do there is we target lower coupon bonds. And for anyone who's taxable, the income you earn in terms of coupon is taxed as income. Mm-hmm. So what we try to do is try to buy bonds that were issued in the last several years when interest rates were lower, coupons were lower, so that the taxable impact of income in your portfolio is lower and the price move of that bond is taxed as capital gains, and that's a higher proportion of your total return. So if you are a taxable investor for fixed income, looking at solutions like this can give you a very similar exposure, but provide you a more beneficial tax bill at the end of the year because your percentage of income versus capital gains is much lower than it would be otherwise. So that's something that I think investors could consider that want to be tax aware when they're looking at their investments.
Absolutely. Okay, the outlook then. Against all that background, what do you think actually might happen? And it's anybody's guess.
Well, I think the market is still grappling with what has the recent action from central bank means in the long term, right? So there still continues to be disagreement about whether the curved version that we've seen and spoken about signifies a slowdown or perhaps a recession in global markets. How long will central banks keep rates up? And the interpretation of the rhetoric is back in vogue to try to kind of anticipate how long and how high will the rates go and for how long. I think what that means, at least for the next little while, is more volatility in the market. And I think the market is pricing that in, perhaps not fully, but is still pricing that in. The other view to be had is that because, as Matt spoke about, rates have been kind of kept artificially low for quite a long period of time, the market is just repricing back to equilibrium. So credit's been super cheap for a decade. We've seen nothing but lowering rates. An interest rate at 1-2% is not natural for the market. And so there is a view to be had that what we're actually seeing and observing in the market is a repricing back to equilibrium. So after this kind of period of volatility, there will be a period where credit will find its natural ballast, and then markets will continue back and find their way back to efficiency. So, we'll all watch and see how that plays out, certainly.
Matt, do you want to add to that?
Yeah, that's very well said, Marina. And I definitely agree with that market trying to find its new equilibrium. I think one thing that I'm quite confident about is that we are nearing the end of a hiking cycle. I can't necessarily pinpoint when that's going to be, but I think in the near term, central banks are going to be nearing the end of their hiking cycle. And then from there, what I expect is higher rates for longer. I don't expect a reversal, of course, by the central banks in Canada and the US in the near term or even over the midterm. I think there is an expectation that we're going to get to a potential economic slowdown, and then immediately the central banks are going to come to the rescue and cut rates again. I think they're going to be hesitant to do so. I think these inflation fears that we have seen thus far this year, they're going to make sure that those are squashed and that inflation doesn't rear its ugly head anytime soon. So that's something that I think we're going to be in an environment where you are going to see higher rates for longer. And I think that is going to be, we're going to see a repricing of risk assets in the fixed income market, in the equity markets. And that's something that is definitely going to lead to some volatility to come.
Marina, Matt, thank you ever so much.
Thank you, Pat.
Appreciate it.
And thank you to BMO ETFs as well for putting together this ETF market insights. Great educational quality and content that we've got here. I hope you enjoyed it. Thanks for joining us.
Adrian Starinari has been using income-oriented strategies in his own investment journey for some time now. He's also the creator of the Passive Income Investing YouTube channel, where he talks a lot about his income-oriented approach to investing. Adrian's also part of the FIRE movement and retired early and is now living in Panama, which is why he's going to be joining us virtually. So now, Adrian, I'm going to turn it over to you.
All right, so there's no question that for aging clients, retirees, they're on the hunt for income solutions and stable monthly income, some younger demographics as well, like myself. So inflation, of course, is dominating the headlines. They're at very high levels globally, all eating into the purchasing power of our money. So this is a key variable on a lot of investors' minds today. So Today, we will cover how covered call strategies are an effective way to enhance income in your portfolio. So we will look at their construction and the important considerations you as an investor must be looking at when evaluating a solution. So I'm very happy to be joined by Chris Heeks, Director, Portfolio Manager at BMO ETFs and Lead PM on BMO's covered call strategies, and Andres Rincon, Director and Head of ETF Sales and Strategy at TD Securities. So Andres has an extensive background in equity derivatives or options. So I'm really looking forward to our discussion today. So let's start off with you, Chris. So many of the covered call solutions, which we will get into more during this session, use a dividend portfolio as the base of the portfolio, which is the most traditional form of income investing, right? Dividends. And then they write call options on that portfolio or the stocks inside that portfolio. So can you quickly take us through why dividends are, first of all, a good base, and BMO's unique screening approach and methodology behind your dividend ETFs?
For sure. Thanks, Adrian, and great to be back with you again. I think when you think about cover call strategies, the immediate traction is that yield, the 6 to 8%, that can help tackle the challenges like inflation you just mentioned. But, one of the most important things is actually where does it start from and what is your underlying equity portfolio? At BMO, we try to construct, multiple different kinds of exposures that investors can build a really strong foundation on. But one of the ways you can do that is with dividends. And dividends offer investors to really benefit from stable and mature companies. Now, I would say, to your point on what's the BMO methodology, not all dividend companies are made the same. Often when a dividend company has that 8% yield, that can sometimes be a sign of increased risk, a possible dividend cut on the horizon. But starting with high quality dividend payers, companies that have been increasing their dividends, companies that have a sustainable dividend policy. So let's say they're making $100, they give back $50 as a dividend. That's a nice solid payout ratio. Those are the kinds of companies that we're after in our dividend strategies. And, it kind of falls into that smart beta. Sometimes we use that word smart beta style of investing. Yes, you could take the broad market, but by going with, a different approach to it, in this case, dividends, can lead to potentially a better result on the risk and return basis. So, it can be a very effective building block for clients. And, especially when it's done the right way, which, I think we're doing at BMO by focusing really on those blue chip dividend payers.
Yeah, I mean, the stock quality is always number one, right? It's always the foundation. Very important to have those great companies. So thanks for that, Chris. So Andres, now let's get into the actual covered call strategy. Now, so can you provide us with a 101 in terms of how a covered call strategy actually works?
Yeah, it's sometimes can seem complicated, but it's actually quite straightforward. So you have two components to it. On one part, you have the stock portfolio, and obviously there's a lot that goes into the composition of a long basket of stocks. And then you have the short call. So what the short call does is, by the name, it's covered calls. It's within the world of yield enhanced strategies, and what they're doing is once again enhancing the strategy or enhancing the yield of your portfolio. In this case, you have short calls, but you also have short puts and a variety of other strategies. If you look at the actual components, so obviously we already talked about the long basket. In the short call, what is a call? You're going to ask. I think a lot of people are going to ask themselves what a call is, and the holder of a call gives you the right, not the obligation, to buy the stock. Now, so if you're on the other side of that, if you're shorting a call, you might need to sell your stock to a buyer. And so that basically what that does is that commitment to sell a stock at a specific price and expiry comes with a yield. So in exchange for that commitment, you are getting a premium, and that premium is enhancing your portfolio of long stocks. Now, when it comes to the call option, you have a variety of options. You can do different strikes, you can have different expiries. So it can vary quite significantly, and the yield of the strategy can vary depending on the strike and the expiry. I know we'll likely get into this in more detail, but you generally have anywhere from 0 to 3 months in expiry, and also relatively close to the money strikes and whatnot. So it can vary quite significantly. But overall, what ends up happening is that you write calls on a long stock position. And if you do that systematically or over time, you're earning that premium on a portfolio, and eventually you're going to get a yield. And Chris mentioned it, let's say 3 to 5% over that long stock portfolio. And put that all together in one package, and that's cover calls for you there.
Yeah, perfect. Thanks for that great overview. So basically, you're writing calls on stocks you love to keep long term, basically, right? So that's the overall. So Chris, tell us a little bit about BMO's specific strategy when it comes to covered calls.
Yeah, for sure. Like, Andres was saying, there's a lot of choices to make, right? When you build that cover call portfolio. And, the way we look at it is there's two things you want to get out of the strategy. Obviously, everyone wants income, and that's a primary driver. But you also want to have some growth from your equities as well. So it's a mixture of income and growth. The trade-off with the cover call is how do you do it so you get both, right? And that's what we want to deliver. So the way we do that is, first of all, we just cover half the portfolio with covered calls. So that allows the other half that's uncovered to fully participate from equity growth. And I know it's been a challenging 2022, but over time we expect equities to deliver growth, and they have historically, right? So that allows half the portfolio to fully participate. And then on the portion we do cover, we always sell those options out of the money. So it allows stocks to go up, a modest amount before they encounter those strikes. And again, that's another feature of what we do that allows more upside participation. So when I look at BMO overall, I characterize it as a very non-greedy approach to cover calls, in that, yes, we're going to get that high level of income, but we do it defensively. And, as we're in 2022, where obviously equities have come down, been challenged, we do expect that recovery to happen over time. Again, by having a less greedy approach, I think that will help set us up for more upside participation going forward, and really allow investors to benefit both on the income and the growth side.
Yeah, thanks for that, Chris. I completely agree. I love how you said both income and growth. Of course, you don't want to write covered calls on the whole portfolio. So BMO does it on half the portfolio. So automatically half of your portfolio fully participates in whatever the stock market does, including when it goes up. And since the calls are written out of the money, even if those calls that are written on half of the portfolio are exercised, you're still participating a little bit in that growth. So non-greedy, like you said. Perfect. Thanks for that. So Andres, let's take a look at the breakdown of the covered call ETF marketplace in Canada. Can you give us sort of an overview of how it's going in Canada when it comes to the covered call market?
Yeah, if I had to give you a broad overview, I would say right now there's about 12 issuers in the covered call space, about 100 products or so in the space. And, it's actually a very substantial part of the Canadian ETF landscape. If you compare it to the US landscape, it's actually very small in the US. It's one of those rare areas where Canada dominates in an area, and Canada's done such a good job, and BMO has done such a good job with call it 60% market share of the space. So it's one of those unique areas that have blossomed in Canada. And why is that? It's because the Canadian investor likes yield, and cover call is an ideal way to get that yield. So if I had to split it into two, you will look at systematic strategies, and you will look at, call it actively managed strategies. Those would be roughly the two ways I would split it. In the systematic strategy, which would include BMO ETFs and many other issuers, you have a rules-based approach to cover call writing. For the most part, these issuers would stick to the rules, and it's clearly outlined what they're doing, how much they're covering, general picture of the strikes and then the maturities. And then on the other side, you have the active strategies, which tend to be a little bit more opportunistic and tend to look for scenarios where they prefer to sell calls and whatnot. So the coverage ratio might change, how many stocks they're selling calls on might change, and the strikes and whatnot. So those is, generally speaking, the two worlds that you have within cover calls here in Canada.
Perfect. Thanks for that. Much appreciated. Chris, before we get into key considerations, in a nutshell, what would you say are the actual benefits of a covered call strategy? Andres kind of touched on it a little bit there.
Yeah, I mean, I think we're getting into it as we discuss it, but obviously it starts with a higher level of income. Like CPI this year is in that 7 to 8% range. There's not a lot of tools that can really sustainably, generate that level of yield. So covered call is one of them. It's an immediate attraction. Tends to lower the volatility of your overall portfolio versus an uncovered strategy. Because if you think of it, we have this income stream from the covered calls, and no matter what, you're getting that high level of income stream. So it tends to dampen out that volatility. There's a tax efficiency benefit that I think we might get into later, but they're very tax efficient strategies. And from the ETF perspective, like all ETFs, kind of frankly, is that one ticket exposure, and you get all those benefits of ETFs: intraday liquidity, low cost, and that ability to get build that exact portfolio exactly how customize it to your needs. So I think there's a lot of benefits, and it can add a lot of value for clients.
If I may add to that, that's okay. The way we tend to look at this is a completely separate asset class, right? Like, we shouldn't be viewed as comparable to a long-only portfolio. So a lot of the attributes that they have is they lower the volatility, like you mentioned. Like, lower vol at the end of the day is a natural impact of selling calls. When you're selling a call, without getting into too complicated of a thing, if you're selling calls, you're selling volatility. If you in your longest stock portfolio, which is long volatility, you're naturally offsetting some of the long volatility of your portfolio. So that is very important, and that's not really seen in a long-only portfolio.
Yeah, I completely agree. And the way I usually talk about it is that if you have two portfolios, the exact same stocks, one of them has the covered call strategy, the other one does not. Well, the one that has the covered call strategy is a little bit more defensive. And you mentioned lower volatility, and that's because that income tends to be relatively stable over time. So like you said, Chris, it kind of cushions if there's a lot of volatility in the market, like what's going on right now. So thanks for that, guys. Andres, what are some of the challenges that these ETFs solve for investors who may be, thinking about doing this strategy on their own? Because, you could actually just buy the stocks yourselves and sell the calls yourself, but instead you could get it with an ETF that's a little bit more hands-off. So what are the challenges that getting a covered call ETF versus doing it yourself fixes, basically, or takes care of?
Let me put it this way. So in my previous role in my history at my current firm, I used to work with some of our clients that used to do this on their own. And I can tell you from experience that this is a very labor-intensive strategy. So when you're paying a manager to do this, you're getting your money's worth in terms of the work that is being done to do this. I'll give you, a quick step by step on how the strategy works, so you get an idea of how much work is involved. So obviously you have to pick the stocks, and then you have to rebalance the stocks if you want to remain within a certain weight or a certain exposure. So that just the long stock portfolio in itself is a lot of work, right? And then you have to start deciding which calls do I sell, which what's the strikes do I sell, which expiry, and you have to look at the volatility curve to see where it makes sense. And then you have to say, okay, well, now that you actually did it, you're long a stock, short a call, then what happens if your call gets called away? Now you're forced to sell your stock, and then you have to buy the stock back again, and then you have to sell more calls. So that's a lot of work, because you have to manage this on a monthly basis, on every 2 months or so. So if you add a portfolio of 10 plus securities, that becomes like a full-time job to just do it, right? So I can tell you that there is a lot that goes into this. There's a lot of analysis. And it's one of those strategies that it benefits the investor a ton to actually do this in a packaged format via an ETF issuer.
Maybe I'll add to that one, if it's okay, Adrian. But just to add to it, not only is it a lot of work, but also the pricing we get. And we partner with, all TD and all the big banks, but the pricing we get, is very attractive as well. So it's another benefit, as an institutional trader, BMO can bring to the table, because everyone wants income as efficiently as possible. So the pricing is, a nice benefit that, people can benefit from.
And not just the pricing, as an institutional client, you can get custom strikes, you can get over-the-counter options. So these are features that are only really done by some of the institutional clients. The average mom and pop on the street is very unlikely to be able to create a new strike on the Montreal Exchange or any exchanges in the US.
Yeah, I think you guys hit the nail right on the head there. It's very complicated to do it on your own. And I've actually spoken to many people who have done it on their own for a long time, and they're transitioning into these covered call ETFs because it's like you said, it's like a full-time job. It's almost like day trading. So it's very, labor intensive. Might as well, have the professionals handle it. That's what I say. I love covered call strategies. I've never written a call in my life. I don't even have options enabled in my broker account. I'd rather leave that to the professionals. Just a quick question for maybe the both of you. Who's actually buying these call options? I mean, especially in a bear market, right? Sometimes investors might be thinking, well, who's actually buying these calls? Because you guys are writing them pretty much every month, right? On the stock. So how would you answer that?
I'll start maybe, and I'll just say, it's a deep market. There's a lot of buyers and sellers, especially in the US, it's a very liquid market and there's a lot of buyers and sellers. But, in Canada, I would say, and have to kind of reiterate, it's a very institutionally oriented market. It's what we call an upstairs market. So we trade, in block trades with, the major institutions. But, that being said, there's a lot of appetite. And sometimes people think about, well, how big can these strategies get? There's a lot of appetite out there. And, we actually, structured the right way, which we always try and do. It's quite a liquid exposure.
Yeah, what I'll say is who are the buyers? Market makers. So there is a large group of professional market makers in options. And their sole job is to quote on options on a daily basis in the same way that we do on ETFs. So most of the major banks in Canada, but a lot of independent shops too, are the market makers for these options, being selling or buying. And one thing that is important to understand is that as a market maker, or in general, market makers are not in the business of taking views on the options. So they hedge themselves immediately. So in the case of an ETF issuer selling a call and a market maker buying that call, they would immediately hedge themselves via the stock underlying the call. So it would be called what we say fully hedged or delta hedged. And in that case, there's no exposure, and their role there is to facilitate trading in that option and create the liquidity for the seller.
Very interesting. So the underlying is that there is an appetite for these call options, no matter the market conditions. That's what I got out of it. So thanks, guys. Really appreciate it. Let's go through some key consideration of these strategies of covered calls. So Chris, what should investors consider when it comes to the options writing strategy on the portfolio?
No, I think let's circle back to that income and growth. What do people want to get out of this? You want to get both. So when you're looking at, there's 10 plus providers out there, you want to just be comfortable with the strategy you're getting. And furthermore, like that construction on the underlying equity is also very important. Like we're going to start with that underlying equity. You want to build a strong house, you got to build a strong foundation first. So looking at those two things, I think is important. I think it's also important to look at the experience of the manager in this case as well. And, it can be a little bit depersonalized. Like, you go on the exchange and you buy a 3-letter ticker, a 4-letter ticker. But really when you're buying that, you're not just buying, a ticker. You're buying, the experience of the manager to deliver you a good experience. And, we've been doing these strategies since 2011. We're leading the market in these strategies. So when you're buying one of, our products, you're not just buying a thing, you're buying our experience in running these strategies. So I think that's something as well that people can consider.
Perfect. Yeah, it makes complete sense. So, Andres, what should investors consider when it comes to the general market environment? This is more of a broad question here. So what should they consider when it comes to the general market environment or market direction when thinking about investing as a whole?
So the first thing I think it's fair to say is that cover call strategies are all season strategies. They do work in every single environment. As I was saying earlier, they should be considered completely different asset classes, right? The focus here is yield. So yield under any single environment. Now, that being said, obviously there are scenarios or environments where covered call strategies do better. And that's times with higher volatility, when you have choppy markets or sideways markets and down markets. So similar to what we are experiencing right now. And it's pretty straightforward. If you have higher volatility, without getting into too much detail, if you have higher volatility, that means that you're going to generate more premiums on the options. Why is that? Well, the main input into an option or a call option is volatility. So if you have more volatility, more premiums, if you have more premiums, you have more yield. If you have more yield, then you have either more upside or growth, as we were talking about earlier, or more yield on your strategy. So generally speaking, higher volatility, choppy markets, down markets are when these strategies tend to do quite well relative to a different group of strategies. But overall, if your goal is to exchange growth for yield, which is what you're doing when you're selling a call over a stock, then these strategies work very well under any scenario and should get you to your goal, which is a certain amount of yield.
Yeah, I agree. It's important that every investor has their own goal. And like you said, I keep saying all the time that cover call strategies are defensive. And now, you basically were talking about why that is. When there's higher volatility, that's when usually, investors tend to be a little bit more scared. So these are more defensive products, which give you more stable income. So this is why, nowadays I'm very happy to be an income-oriented investor where the bread and butter of my strategy is really covered calls. So very, very interesting. So something that's been dominating the headlines is, of course, rising rates, right? Rising interest rates. So how can, higher interest rates affect or impact a covered call strategy?
So it's like Andre said, volatility is the most important input to the price of an option. And more volatility, and we've had more volatility, can lead to more yield and more kind of attractive outcomes. But another input is the interest rate. And we're looking in Canada, interest rates have gone up about 300 basis points or 3% this year. When you plug that into the formula, you actually get another % of income on the options. So again, this isn't the primary driver of an option price, but it is nice that with the covered call strategy, even in this choppy environment, but with higher interest rates, you can generate a little more income. So, again, if that target is between 3 to 5% that we have, helps us get, to our targets and maybe towards the upper end of those targets. So overall, it's a good factor, and I'll just go back to it again. Helps keep pace with inflation from a yield perspective.
Okay, good. So it's actually a good thing. It actually does help a covered call strategy. That's good because and this is maybe an extra question for you guys. How would you respond to investors who really want that safety but are invested in more fixed income and bonds? What would you say the advantage that a covered call ETFs have over the more traditional fixed income type of securities?
I'll just start by saying, we think both have value and a place in portfolios. Fixed income is getting a little more interesting now. Like we're seeing yields on the short end and that 4 or 5% level, sometimes north of 5%. Is very nice, but the thing we also have to remember is inflation's still 7%. So to deal with inflation, and also, fixed income pays you a coupon. Fixed income doesn't pay you capital growth. So, an investor who wants both income and growth and wants to keep up with inflation and hopefully surpass inflation, you got to have that equity element in there. And the covered call can give you that equity element, but again, with that higher level of yield. So, I think it's not one versus the other, but you want both.
Yeah, very interesting. I will also add to that, and Chris, you kind of touched on it earlier. You said very tax efficient. Covered call strategies are tax efficient because the premiums, they're not taxed as interest or dividends, they're taxed as capital gains, which is taxed much better than interest in Canada, right? So I would say that's also another advantage these strategies have over traditional fixed income. So thanks, guys. Really appreciate that. Now let's talk about fees. Of course, I'm sure you guys get a lot of questions about fees. So Andres, fees are, they're obviously it's a very obvious consideration. So what are the best practices when it comes to evaluating the fees on these types of ETFs, covered call ETFs?
No, and that's a very good question. It's very important that you look at total cost of ownership, not just the management fee. Most advisors, most clients look at fee and they just go to a web page and they'll see management fee and they'll say, okay, that's the cost. But in reality, that's one part of the cost of ownership. You should look at obviously at total cost, which is MER, and also the TER, so the management expense ratio and the trading expense ratio. If you add those up, you're going to get the total cost of ownership for an ETF. Now, where do you get this information? Regulatory documents now mandate that a lot of the issuers publish this on their websites, so you can go and find the fun facts in many of the websites of the issuers, and it should say there what the MER and TER is for these specific ETFs. And just to step back for a second and explain them, so the management fee is basically the investor paying for the fund manager to implement the strategy. But then in order to implement that strategy, you have operating expenses. And those operating expenses add up to the MER of the fund. But you also have trading expenses. And those trading expenses are not really shown in the MER. So those are shown in the TER, or the trading expense ratio. So those are very important because although generally speaking, they're fairly small, they do add up and give you the total cost of ownership. So what I would say is important to do your homework, understand the MERs and the TERs of different ETFs, not just the management fee, and then use those as part of your decision-making process to selecting an ETF.
Yeah, and what I would add to that is that all the management fees, the MERs, is all disclosed on the fund's official website online. I always tell people, go on the official fund's website, ETF website, look at the fact sheets, and all the information is there. And another thing I would say also is that some, especially newer investors, get kind of confused of how actual management fees work. The way I like to explain it is they're kind of included in the fund, which means that their distributions or the dividends are all net of management fees as well. Do I have that correct?
That's correct.
Okay.
And by the way, the website is a brand new website as of this fall. So please visit the BMO ETF website. I'll put a plug in there. Good
to know. Good to know. Excellent. Excellent. So Chris, speaking of BMO's website and BMO's ETFs, you guys have a big selection when it comes to covered call ETFs. Like we discussed earlier, BMO has about 60% of all the covered call stuff in Canada. So can you give us an overview of a few of your covered call solutions?
Yeah, for sure. Thanks. I mean, we started talking about the dividend ones, starting from a dividend base and then implementing the covered call. So that's our high dividend covered call suite. ZWC, ZWH, ZWE, that's Canada, US, Europe. We've got a global ZWG. So again, if you're looking for that equity income exposure diversified across sectors, high dividend covered call suite. And then we have more sector strategies with a covered call. And our first covered call that we launched was ZWB on the Canadian banks. And Canadian banks, again, are great dividend growth machines over time. But ZWB writes calls upon those Canadian banks, it's yielding close to 7%. We also have US banks, utilities, which has fared a little bit more as well in this challenging market, and even technology, which is a great example, and just in terms of how we can take a non-income producing asset like technology companies, but bring that yield up, into that 5-6% range in that case. So so we've got core strategies and we got sector strategies, and they can be found on our roadmap, and and we talk about them, on our market insights as well.
And I think that's an important point you made, because many investors will have non-yielding parts of their portfolio, and in times where yield is important, covered call strategies allow for that creation of yield in an area where previously there was none.
Yeah, perfect. So I like the BMO lineup. I like how you guys have two separate kind of, like you mentioned, you have your regional, I call them the regional dividend ones, where you could get, ZWC, you could get the Canada, the US, Europe, global, and then you have your sector specific ones. If you like a particular sector, you believe in a particular sector like tech, which is very, very hard to get yield because technology stocks usually don't have dividends, right? So it's a good way to get some yield off technology stocks. So I thought that's very, very interesting. So what about investors? This is for Chris again here. What about investors looking for an all-in-one diversified cash flow solution? What is a simple way investors could get started with an income approach to investing? Let's say if they're a bit newer to income investing.
Well, there's a couple different ways to look at it. The one we just talked about, the ZWG, it's global equities with a cover call overlay. So from an all equity perspective, there's that solution, which is, it's all cover calls and has all the benefits that we're talking about, and certainly a healthy yield. Also within the kind of what I call the balance space, and we think of a 60-40 balance portfolio, we've got the ZMI, which is the BMO monthly income ETF. It combines our dividend ETFs along with that ZWG global covered call, and then also has an element of fixed income, mostly corporate bonds, because they offer a little more yield than governments. So that's another kind of all-in-one solution that can, take advantage of these strategies.
Yeah, perfect. And one thing I really like about these types of solutions, and for all the ETFs you mentioned, they have monthly payouts, which is really, really cool, because if you would just buy, the individual stocks on their own, or if you're doing it on your own, you typically get a quarterly payout. So getting a monthly payout is really nice, in my opinion, especially if you're an income-oriented investor, you're a retiree, and you want that monthly income. It's much better than, waiting every 3 months, I would say. So another cool little advantage with, these types of products. So guys, thanks so much for discussing these income-oriented solutions. It covers, we're finished our discussion. So thanks so much to Andres and Chris for bringing such great insights around covered call ETFs, as well as the considerations, right, that you need to look at if you're trying to adopt or implement this enhanced income approach to your portfolio. So once again, thanks to BMO ETFs to continue to host these educational segments for do-it-yourself investors. And hopefully we speak again soon. Have a great day, everyone. Take care.
Yeah.